if you're stuck between starting to invest or waiting for the right moment, this video is for you. Deep down, you already know investing is the right decision, but you keep delaying it because you think you don't have enough money or that now isn't the right time. By the end of this video, you'll know exactly what decision to make step by step and how to properly prepare before you invest a single dollar. Let's start by understanding why investing is so important. Inflation is the invisible thief that slowly steals your money without you ever noticing it. Every year, prices go up. Food, rent, energy, transportation. Everything becomes more expensive over time. And if your money is just sitting in a bank account, its purchasing power is quietly shrinking. Let me give you a simple example. If you have 10,000 euros saved today and inflation averages around 2% per year, in 10 years, that same 10,000 euros will only have the purchasing power of about 8,200 euros. You didn't lose the money, but you lost what that money can buy. That's why inflation makes you poorer without asking for permission. Doing nothing with your money is not neutral. It's a decision, and usually it's the wrong one. Now let's talk about something even more dangerous than inflation. Opportunity cost is the return you give up by not investing. When your money stays idle, you're not just losing purchasing power, you're also missing out on potential growth. Markets don't grow in a straight line. There are ups and downs, good years and bad years. But over long periods of time, markets grow. That's why every year you delay investing comes at a cost. You don't just lose 1 year of returns. You lose all the future growth that could have compounded on top of that year. This is why waiting for the perfect moment is so expensive. The real cost isn't making a small mistake. The real cost is never starting. And if you think you're late or behind, here's something important. According to a BlackRock survey, only about 34% of adults in Europe invest in financial markets. That means 2 out of 3 people never invest at all. Most people don't fail because they make bad investments. They fail because they never start. Compound interest gives you 2 options. You can make it work for you or against you. The choice is yours. Albert Einstein reportedly called compound interest the 8th wonder of the world. And whether he actually said it or not, the idea is absolutely correct. Compound interest simply means that your money earns returns. And those returns then start earning returns themselves. Over time, this creates an exponential effect. This same force can build wealth if you invest early and stay consistent. Or it can destroy wealth if you ignore it and let inflation work against you. The difference is simple. Is your money working for you or against you? When you invest, you're putting your money to work. You're no longer relying only on your salary. You're using time, discipline, and mathematics to your advantage. And the earlier you start, the less you actually need to invest to achieve meaningful results. Now keep this in mind. The average gross salary in Europe is around 3,100 euros per month. And that's just an average, so there are many people who earn less. With that level of income, it's extremely difficult to reach financial freedom by relying on salary alone. Not because people don't work hard, but because income has limits and time does too. That's why compound interest matters. It's how money scales when you can't. And that's why investing isn't optional. It's how you stop trading time for money forever. Before you even think about investing, there's one rule you cannot ignore. Don't invest while carrying high interest debt. If you have debt with interest rates above 8%, you should not be investing yet. Why? Because the cost of that debt is higher than the realistic returns you can expect from investing, especially in the short and medium term. If your credit card charges 15, 18, or even 20% interest, while the market averages around 7 to 8% over the long term, you're losing money every single year, no matter how good your investments are. Paying off high-interest debt is a guaranteed return. Investing is not. That's why the correct order is simple. First, eliminate expensive debt. Then start investing from a clean base. This one decision alone can save people years, sometimes decades, of financial stress. Before investing, you need an emergency fund. This rule is not about returns. It's about survival. Why is this so important? Because emergencies don't care about markets. If you don't have cash set aside and something unexpected happens, like losing your job, facing a medical expense, or dealing with an urgent repair, you'll be forced to sell your investments at the worst possible moment. That's how most people lose money. Not because investing doesn't work, but because life happens. A simple rule of thumb works for most people. If your job and income are very stable, aim for 3 months of living expenses. If your income is uncertain, flexible, or unstable, aim for 6 months. This money is not there to grow. It's there to give you peace of mind and flexibility. An emergency fund protects your investments, and just as importantly, it protects your psychology. This is where most beginners make mistakes without even realizing it. Before you invest, you need to answer one simple question. What is this money for? Is it for retirement? To buy a house? To achieve financial independence? Or to secure your family's future? And just as important, when will you need this money? In the short term, the medium term, or the long term? Your time horizon determines everything. It defines what you should invest in, how much risk you can realistically take, and how you should react when markets drop. Money you'll need in just a few years should not be exposed to high volatility. But money you won't touch for decades can handle ups and downs and actually benefit from them. If you don't define this upfront, you'll panic at the wrong time and make emotional decisions that hurt your results. Clarity comes before returns. When people start investing, one of the biggest mistakes they make is trying to do everything at once. So let's simplify this and walk through the main types of investments available in Europe, what they actually are, and when they make sense. Let's start with the most common option, traditional savings. Savings accounts and fixed-term deposits are what most people are familiar with. They are safe, easy to access, and useful for short-term needs. That's why they're perfect for emergency funds or money you might need soon. The problem is that their returns are usually lower than inflation. So while your money feels safe, its purchasing power slowly declines over time. Savings are not bad, they're just not designed to grow your wealth. When you buy a bond, you're essentially lending money to a government or a company in exchange for interest. Bonds are generally more stable than stocks and provide predictable income, which is why they're often used to reduce volatility in a portfolio. However, bond returns are usually lower than equity returns, and inflation can still erode their real value over time. Bonds are useful for stability, not for aggressive growth. Stocks exist because companies need capital to grow. When a company wants to raise money, it can go public through an IPO, an initial public offering, and sell shares to investors. By buying a stock, you're buying a small ownership stake in that company. As a shareholder, you can make money in two main ways: through dividends and through an increase in the stock price. The price of a stock is constantly changing because it's driven by supply and demand. If more people want to buy than sell, the price goes up. If more people want to sell than buy, the price goes down. That's why you see stock prices move every second. Individual stocks offer high return potential, but they also come with higher risk. Companies can underperform, industries can change, and emotions play a huge role in price movements. That's why investing in individual stocks only makes sense if you're willing to spend time learning how to analyze businesses properly. Without analysis, investing in individual stocks quickly turns into speculation. In a future video, I'll walk you step by step through how to analyze individual stocks, how to understand if a company is solid, and how to evaluate whether a stock is expensive or cheap, so you can make informed decisions instead of guessing. ETFs, or exchange-traded funds, are funds that track an index, such as the S&P 500 or the MSCI World. When you buy an ETF, you're automatically investing in hundreds or even thousands of companies at once. This gives you instant diversification, low costs, and simplicity. You don't need to pick winners or time the market. For most beginners and long-term investors, ETFs offer the best balance between risk, simplicity, and long-term returns. Examples include global ETFs like VWCE or developed market ETFs like IWDA. It can provide rental income and diversification, and it's a tangible asset many people feel comfortable with. However, buying property directly usually requires high initial capital and involves active management, taxes, maintenance, and low liquidity. It's not passive, and it's not accessible to everyone at the beginning of their investing journey. That said, there is a simpler and more accessible way to invest in real estate: REITs. REITs, or real estate investment trusts, allow you to invest in property without owning physical real estate. When you buy a REIT or a REIT ETF, you're investing in a diversified portfolio of properties managed by professionals, such as residential buildings, offices, shopping centers, warehouses, or data centers. REITs offer lower entry barriers, high liquidity, diversification, and often provide regular income through dividends. This makes them a much more practical option for beginners who want exposure to real estate without the complexity and responsibilities of owning property directly. Commodities are often used as a hedge and a diversification tool. They can help protect purchasing power in certain economic environments and reduce overall portfolio volatility. However, commodities do not generate cash flow and do not benefit directly from compound interest. Because of that, they are usually not a core growth asset. For most investors, commodities only make sense as a small allocation, added later on, not as a starting point. Is the most controversial asset class. It offers high upside potential and is driven by innovation. But it also comes with extreme volatility, regulatory uncertainty, and strong emotional pressure. That said, high risk doesn't mean bad investment. Crypto can make sense as a small part of a diversified portfolio as long as you understand the risks. I'll explain crypto properly in a future video, so you can approach it in an informed and disciplined way. With peer-to-peer lending platforms, you lend money directly to other people or companies, without going through traditional banks. The platform acts as an intermediary. It connects lenders and borrowers, handles payments, and manages the process from start to finish. But banks are not involved. In Europe, examples of peer-to-peer platforms include Bondora, Mintos, and Peerberry. These platforms can offer higher interest rates and more predictable cash flows compared to traditional savings accounts. However, the risk is also higher. If the borrower doesn't repay, you can lose part or all of your money. There's also platform risk, and your money is usually less liquid than in traditional investments. That's why peer-to-peer lending should be seen as a diversification tool, not a core investment, and only used with money you can afford to take some risk with. These funds offer diversification and active management, but they usually come with higher fees and complex structures. Over long periods, those fees significantly reduce returns, and many actively managed funds fail to beat the market consistently. More importantly, most of these funds are not designed for beginners or small investors. They are often created to fit institutional needs, distribution models, or regulatory structures, not to help individuals build wealth efficiently from scratch. That doesn't make them useless. It just means they are not the best starting point. For most beginners, simplicity, low costs, and transparency matter far more than complexity or professional labels. So why does long-term investing usually win? Because short-term markets are noisy, emotional, and unpredictable. But over long periods, economies grow, companies innovate, and markets tend to move upward. The best investment strategy isn't about being smart. It's about being patient. For most people, the best approach is simple: low costs, diversification, consistency, and time. That's why, for beginners especially, ETFs are often the best place to start. Not because they're exciting, but because they work. Now let's talk about one of the biggest differences in investing: short-term versus long-term. If you don't understand what you're doing, don't do it. Especially in the short term. Short-term investing is where most beginners lose money. It's driven by trends, hype, memes, tips from social media, and group chats promising fast gains. Meme coins, hot stocks, and inside information usually end the same way with losses. In the short term, markets are extremely volatile. Prices can move up or down sharply from one week to the next, sometimes for reasons that have nothing to do with fundamentals. A single news headline, a central bank statement, or even a political comment can shake markets overnight. That's why short-term returns are unpredictable. But the long term is different. Over long periods like 10, 20, or 30 years, volatility smooths out and growth becomes visible. Economies expand, productivity increases, and companies adapt and innovate. That's why the long-term trend of the market has historically been upward. For example, over the last 100 years, the S&P 500 has delivered an average return of around 7% per year, adjusted for inflation. Not every year is positive. Not every decade is easy. But over time, patience has been rewarded. This is where patience and consistency matter. Investing is not a sprint, it's a marathon. You don't win a marathon by running as fast as possible at the start. You win it by maintaining a pace you can sustain for decades. Trying to invest at the perfect moment is a mistake. Timing the market consistently is impossible. If it were possible, the person who could do it would already be the richest person in the world, and they wouldn't be sharing tips online. Long-term investing doesn't require prediction. It requires discipline. By investing regularly, staying consistent, and ignoring short-term noise, you let time do the heavy lifting. Markets reward those who stay invested, not those who jump in and out based on emotions. That's why, for most people, time in the market beats timing the market. Now let's talk about strategy. A good investment strategy doesn't need to be complex. It needs to be consistent, automated, and realistic. The first step is to define a fixed monthly amount to invest. Decide how much you can comfortably invest every month, whether it's 50, 100, or 200 euros. The amount matters far less than the habit. What really makes the difference is showing up every single month. Once that's defined, automate the process. Set up an automatic transfer to your broker right after you receive your salary. Pay yourself first. This removes emotion from the equation and turns investing into a system instead of a decision you have to make every month. After that, stop checking your portfolio every day. Markets move daily, sometimes violently, and watching every fluctuation will only mess with your emotions. The long-term trend of the market is growth, even if the short-term path is noisy. Checking your portfolio once a month is more than enough. At the beginning, it's normal to constantly check your investments and react emotionally to small ups and downs. I went through the same thing. Today, I react far less emotionally to my portfolio being down 900 euros in a single day than I did when it moved by 10 euros in the beginning. The goal is to reach a point where you don't even feel the need to check your portfolio because you trust the process. Another important rule is to reinvest dividends. By reinvesting dividends, you allow compound interest to work fully in your favor. This is one of the simplest ways to accelerate long-term growth without increasing risk or effort. Most importantly, think in decades, not days. Success in investing comes from consistency and time in the market, not from quick decisions or perfect timing. Anyone who invests consistently for 20 or 30 years, even with small amounts, almost always ends up winning. That's why time in the market beats timing the market. At the beginning, investing in a single broad ETF, like one that tracks the S&P 500, is more than enough. In fact, I'd argue that almost everyone should start there. It's simple, diversified, low cost, and extremely effective. A real cheat code for long-term investing. Later on, as your knowledge and confidence grow, you can diversify further. You might add exposure outside the US, invest in emerging markets, or even include assets like gold-related companies. All of that can come later. The most important thing is not to build a perfect portfolio. It's to start. Before we finish, let's talk about the most common mistakes beginners make and how to avoid them. The first mistake is investing without an emergency fund. If an unexpected expense shows up and you don't have cash set aside, you'll be forced to sell your investments at the worst possible time. That's why an emergency fund is non-negotiable. As a general rule, 3 months of expenses if your income is stable, 6 months if your income is unstable or uncertain, This single step protects your entire strategy. The second mistake is panic selling during market drops. Markets fall, and that's normal. But selling during a downturn locks in losses. And buying again after prices recover is not a strategy. Think about it this way. If the laptop you want suddenly goes on sale, would you avoid buying it? Market drops are uncomfortable, but for long-term investors, they're often the best moments to stay consistent or even reinforce positions. The third mistake is trying to predict the market. No one can consistently forecast short-term movements. If that were possible, that person would already be the richest person in the world. And they wouldn't be sharing tips online. Successful investing is not about prediction. It's about preparation. The fourth mistake is constantly changing strategy. Jumping from product to product because you saw a new tip on TikTok or social media destroys consistency. A strategy only works if you give it time. Consistency is powerful because mathematics and history are on your side. The fifth mistake is following gurus instead of data. Be very careful with promises of fast money. Trust credible sources, long-term data, and simple systems, not hyper shortcuts. So how do you avoid all of this? Stick to your strategy. Invest regularly. Diversify. And only invest money you won't need in the coming years. Investing is not just for the rich. It's for anyone willing to be patient and disciplined. And remember this, knowledge without action is just entertainment.